Thank you, everyone, for joining us for the Supply Chain Reaction webinar with the Appraisal Buzz, sponsored by Metro West. We appreciate your time. We have some fabulous speakers today to discuss this issue, and I'll start it off with Greg Stevens. Greg, I'll hand it over to you.
Well, thank you, Jim. Thank you so much for that introduction. Welcome, everyone, to the fourth in the series of Metro West Appraisal Buzz webinars. I want to give a big kudos to Jim Morrison and IMR Waters from Appraisal Buzz, for Mike and Randy Fasano with Premier Communications for helping coordinate this webinar with Metro West Appraisal Company. I also want to thank our COO, Brandon Boudreau, for his exceptional leadership, and to Don and Joni Russo for founding Metro West Appraisal Company over 35 years ago, and their continued support and sponsoring of these webinars. So 2021 has proven to be a very interesting year for the industry. On a positive side, we have been experiencing continued historic low interest rates attracting borrowers. That's good for the mortgage lenders, facilitating the refi market. We've continued strong demand for housing, which is good for the construction industry. It's been good for the mortgage lenders financing the new home purchases. It's also good for the brokers and agents facilitating the buying and selling of existing homes, as well as new construction. It's been good for us appraisers, providing the asset valuations of both the existing and new construction transactions. Sounding pretty perfect, right? Unfortunately, we have been and continue to experience an imbalance between demand and the availability of resources that are impacting virtually all of the industry participants. We all fit somewhere in the supply chain. Builders are not able to keep up with the demand for new construction, and it's not just the shortage of lumber that we have been hearing about. My stepson works for an electrical distribution company that supplies commercial and residential builders. He recently advised me of a shortage of electrical wire, even PVC for plumbing. The builders are not able to get the PVC to finish out the plumbing in these new homes. Real estate agents are now tasked with trying to price houses in step with the dramatic price increases, resulting from the demand far outpacing existing and new construction, writing an increasing number of contracts that state the purchasers commit to the deal, whether the appraisal supports the contract price or not. Appraisers are challenged with keeping up with the price increases as well as volumes that impact turn times, which then impact the lenders and borrowers trying to schedule rate locks and closings. So with the 2020 pandemic and the dramatic work from home shift, we now even see urban workers moving to suburban and even rural markets, creating even more disruption in the supply-demand balance as well. With all these going on, we thought it would be timely to bring back our panel representing some of the industry's most significant participants involved in the supply chain. National Association of Home Builders, National Association of Realtors, and the Appraisal Institute, representing the largest appraisal organization in the country. They're going to provide us with an update on what they and their members are experiencing, what they see lying ahead in the balance of 2021 and beyond. So our panelists are going to be, if we can get that to come up. It's not advancing. Oh, there we go. So our panelists are going to be Bill Garber, Director of Government Relations with the Appraisal Institute, Sehar Siddiqi, I keep getting that wrong, Director of Fair Housing Policy and Valuation for the National Association of Realtors, and Jessica Lynch, Vice President of Housing Finance at the National Association of Home Builders. So leading us off today is going to be Bill Garber. So we're going to have Bill Garber take it away, and he's going to give us his presentation. Little background on Bill. As a Director of Government and External Relations for the Appraisal Institute, he serves as head of the AI Washington operations, representing the interests of AI members before Congress, federal agencies, and outreach to aligned real estate organizations. He has more than 20 years of association, lobbying, and management experience in the real estate and economic development professions. He serves as the liaison to the Appraisal Institute's Government Relations Committee and Client Advisory Board, and as treasurer of the Appraisal Institute Political Action Committee. Bill has testified before Congress. He's a frequent speaker before government agencies and industry organizations. He was also instrumental in development and passage of the appraisal provisions found in 3 of the last major housing finance bills in Congress. So we look forward to your comments. Bill, go ahead and take it away.
Well, thanks, Greg, for the very welcome, a very warm welcome this afternoon. And it's really good to see my colleagues, and I hope everybody is doing really well. Big thank you to Appraisal Buzz and to Metro West for the invitation to participate as well. I think mine's going to be less of a presentation, more meandering thoughts relative to appraisal this afternoon. But I'm happy to try to share some of the intelligence and some of the information that we're tracking and gathering at the Appraisal Institute. I think moving through the slides themselves. Let me gather this up. Here's my quick outline. So I think it's fair to say at the outset that demand for valuation services exceeds supply for those services. And I think by a significant amount as well. And I think it's important to understand the full range of the valuation service space in making that comment. We're talking about not just appraisals in valuation services, but alternative valuation services like broker price opinions or automated valuation models. But more pointedly, what's driving some of those services are a range of end user needs in the marketplace. And I think traditionally the appraisal space has really gravitated around the more bread and butter type of an appraisal assignment, or frankly, the more complex of appraisal or valuation assignments in the marketplace, whether that be for a purchase transaction or for a refinance transaction with greater risk, or an atypical market or property type of an appraisal assignment. What appraisers have developed and culled over time is a great deal of economic security around bread and butter evaluation services that we know as appraisals, traditionally done on a 1004 form or in a narrative component for other reasons. And there's been an entire profession that's been built up around that with standards and qualification criteria and an entire enforcement and regulatory structure. But lying outside of that is a very significant realm of non-appraisal valuation services. The BPOs, AVMs are 2 of those. There's different types of variants thereof that we see. And those are typically used for other reasons than bread and butter type assignments, where there might be less risk or there might be different business needs in the marketplace. For example, evaluations is a concept that is born of the bank regulatory regime. There are allowances that are given to regulated institutions for the use of evaluations in their lending decisions or their portfolio management, and that lies outside of the appraisal space. There's criteria for evaluations. Appraisals can be part of that mix, can be delivered by, the evaluations can be delivered by appraisers, but they don't necessarily have to be delivered by appraisers. They can be delivered by others with relevant experience in valuation. So there's an entire world that is open to non-appraisers and delivering valuation services born of the bank regulatory processes. The world of the secondary market as well is often looking at different types of loan decisioning or portfolio management. There might be situations, as we've seen recently with the refi situation, where risk is actually being reduced in the loan by reducing an interest rate or reducing the term of the loan. And an appraisal or the valuation of the property is largely a secondary consideration because the loan itself and the risk associated with it is actually being reduced by other measures. So as institutions, they can look at that a little differently with lesser forms or products or cascading approaches in evaluating their collateral risk. That's why you see waivers used in that space. It's why you see automated valuation models and other types of services that are really geared towards that lower risk environment. But as far as trying to quantify that gap between demand and supply, it can be difficult because that non-appraisal valuation service realm is so significant. And I don't think a lot of appraisers realize how much non-appraisal valuation services are done. But it's safe to say that it is an opportunity to appraisers in the sense of if they were to right size that service for the risk model and deliver a streamlined or a more pared down type of valuation assignment that suits that need, that there's tremendous opportunity within that space. It would be less rigor on the development side and the reporting side. We might even think of it in some of these cases, some of these situations, there are different questions that are even being asked of the valuation service provider or for the order of the valuation service. As an example, in typically where you see these are in existing loans, in subsequent transactions, refinances, modifications, or portfolio monitoring. And the question is not necessarily what's the value of this property today. The question might be, is it worth as much as it was when we made the original loan? So that's a relational question. That's actually one that could be provided by appraisers as a relational value construct or a validation assignment. This world of validations and alternatives, alternatives may not be the right word, but these types of services that are not necessarily bread and butter, as I said earlier, but suiting different needs of end users is really a space that I see that appraisers are only scratching the surface today, and there's opportunity to try to build out as a profession going forward. I do want to say I know some of the commentary that's been out in the blog sphere, social media, and in publications has revolved around the use of waivers by the GSEs primarily. And I think obviously waivers are a significant issue going forward within the marketplace. The use of technology and automated systems and the like, I think, is clearly with us. I think the application thus far of those waivers has been generally judicious, though, and that might surprise some people coming from an appraisal organization to say that. But I think it's largely because of that point I tried to make earlier, that a lot of the transactions that we've seen in the low interest rate environment are are situations that lower and reduce the risk of these loans. With the lower interest rates, we've seen record refi activity, and people dropping down into lower rate and term mortgages, which has been a good thing for consumers as a whole. It's been a good thing for risk as well within the banking system. It's much stronger because of some of those changes. And again, the collateral value is not necessarily something that's a significant question in a situation like that. The bulk of the waiver activity that's occurred within the GSE space, or the bulk of that activity, has been in that refi space, where appraisal or collateral valuation is of limited question. Generally speaking, in the higher risk transactions, appraisals are still being performed in that space. You're seeing, I think, a rate of around 10% appraisal waiver in a purchase transaction, which is frankly where the GSEs had committed to trying to retain it. And I think moving forward, there will be questions about those figures, but from a management standpoint, a risk management standpoint, it seems very reasonable, and almost proper, to utilize a lever such as that in those situations where rate and term risk is dramatically reduced. Now, going forward, will that risk exist going forward? I think that's a significant question. We're at arguably the height of the market, and we've got a lot of uncertainty around the issues of foreclosures, rent forgiveness. You've got different eviction related rules that are still triggered from COVID that have not been broached yet in the marketplace. You still have COVID impacts from an unemployment standpoint, and then you have some of these cost and affordability questions that are also looming in the marketplace. So will those affect market risk going forward? And will the application of that kind of a waiver process exist the same way it has over the last 12 months? I don't know the answer to that, but I would highly doubt it, because I think this has been a rather unique period of time, with the pandemic being a significant driver of loan demand in the marketplace, particularly on the refi space. Let me just go through a couple of other issues. The use of hybrids, I think, obviously is something that's being advanced by certain sectors and quarters in the market as an additional alternative. We've seen in the COVID arrangement that appraisers have been effective in delivering exterior only or desktop appraisals in response to the pandemic. I think appraisers' performance has been excellent and exemplary by the data that's existed on that topic. I am concerned for the future of the profession in addressing the supply side issues with the hybrid or bifurcated product that undercuts the future next generation of appraisers. There are sectors that are advancing constructs of alternative workforces to be conducting significant portions of the valuation process that lie outside of the appraisal space. The issues of trainees, and the eligibility for experience requirements really stand against development of the next generation of appraisers. And I think we need to be mindful of that moving forward, and try to find ways to look at trainee inspections, to allow for greater use of trainee inspections, and not bypass or undercut the regulatory environment and the development of the next generation of appraisers to address some of the supply side questions that remain in the marketplace. I think too, we've talked a little bit about stakeholder issues. The efficiency of appraisal process can always stand improvement. We've got a lot of work to do to increase communications between the stakeholders, home builders, real estate agents, and others, as far as listening to them and hearing their information and interviewing them. We need their help in gathering information so they can help appraisers by providing information in a timely manner or responding to interview requests, inspection of scheduling. And appraisers too can help address some of these issues by being responsive, by focusing on customer service, and being thorough in their work. I think too that this next period ahead, we are, with all of the attention on equity and civil justice in the marketplace right now, we are going to see a big push ahead about reconsideration of value process by financial institutions. That's undoubtedly going to affect appraisers and their communications with agents and other stakeholders. Programs like the Tidewater Initiative and the HUD reconsideration of value process are being looked at right now as models for potential build out or development of a more general guidance on this topic for the conventional market, as there's been a series of complaints about how those processes have been handled by banks. And I think that speaks to just listening and being mindful of the marketplace. It's been some time in the past where an appraisal that may have been below contract price, there might have been kind of a general courtesy given to the stakeholders that the appraisal was coming in below contract price, and I see almost a potential for a return to that kind of a construct in even a more formalized way through maybe a notice of value or some other Tidewater-like initiative that the VA deploys moving forward. And I expect that that'll be part of the Biden administration task force that's being stood up right now, looking at consumer issues. Very quickly, I've talked about trainee issues. I think really and experience requirements. There is kind of a challenge that's facing the appraisal profession as far as being responsive and really listening to the current marketplace, finding the next generation of appraisers, reducing and eliminating barriers to entry in appraisal. The experience requirement has been identified as an issue in several capacities. If appraisers are going to keep the experience model that we currently have, we really need to address some of the different pitfalls and some of the challenges that trainees face in that regard. The PREA type concept has promise in this area. I think it's actually an opportunity, but it really needs to be delivered in an effective way. It needs to be presented and made available to the marketplace. And I think there may even be attempts moving forward to find alternatives to this process going forward. And so I think, kind of in sum, I think it goes without saying we can't really address these issues by ourselves. We do need help and assistance from our stakeholder organizations, the end users as well. And, when it comes to trying to develop the next generation of appraisers, trying to foster supply side reactions to this, we need to be looking at our policies here, installing policies that are trainee friendly, allowing for trainees to conduct inspections as another example, and also relative to these hybrid or bifurcated processes, not deploying different services that are going to undercut the very proposition of the next generation of appraisers. So those are some quick thoughts, Greg, and happy to respond later to some questions.
Well, thank you, Bill. Much appreciated. As usual, very informative, and we do appreciate that. Our next presenter is going to be Sehar Siddiqi with the National Association of Realtors. Sehar began her career working as a securities attorney in New York before joining the DC housing and finance world. Currently, she works on property valuation, fair housing, and federal loan financing issues for NAR. She holds a BA from the Ohio State University and a JD from the University of Michigan Law School. So we look forward to her market update today. Sehar, the mic is yours.
Thank you so much for that wonderful introduction. It's so kind of you. I'm told I'm having some camera issues, so I'm going to be turning off my camera for now, but rest assured I am here and happy to speak. And, thank you to everyone for joining today. So I was really excited to become a part of this webinar when I heard that I was talking about supply, because right now for the realtors, not just the realtors, if we're talking about supply and we're talking about real estate, we're talking about the dearth of availability of residential properties right now. And that is a major, major concern for our membership. So I'm going to go through just a few numbers right now to kind of put things in perspective. So I did want to share that, in May 2021, and most of my stats are from May because that's the most recent ones we have analyzed right now, the median home price in this country reached an all-time high. In fact, the existing home price for all housing types saw a record year-over-year increase of 23.6% in May 2021. That is almost a 0.25% jump, which is remarkable, especially when you look at historical increases. Properties sold in an average of 17 days. That's just a little over 2 weeks, and this is the national average. There are some markets, for example, I live in the DC area where properties sell in 3 or 4 days. So, that tells us something about how much people are willing to pay for a property and how quickly they are willing to move forward with a property. What's interesting is that as you see this crazy increase in price, this frenzy in trying to get a house, the actual number of sales, so the existing home sales numbers, are down for the 4th consecutive month, which means that there's less homes being sold, and it's not just that there aren't sales going on. I mean, there's just less homes, and that's something we're going to dig in a little later. But going back to the transactions, 7% were actually cash transactions. That is 23% more from last year. So again, we have seen another doubling from last year. So what is going on with that? That's really, really strange to see a cash transaction that high. In addition, when you're looking at a listing, when you're looking at an offer situation, the average is that there are 5 offers at any given time. And then half of all the homes that are sold, so with these offers, they're above list price. So I hope everything I'm talking about is again saying like things are kind of in a frenzy right now, especially when we're talking about the residential market. One thing that concerns us with this frenzy, the affordability gap when it comes to housing, is actually getting worse. For example, the monthly mortgage payment rose by 1.7%, but then the median family income declined by 1%. So you've got a bit of a mismatch. According to our lead economist, Lawrence Yun, the lack of inventory continues to be the overwhelming factor that is holding back home sales, but the side issue of affordability is also just squeezing many, many buyers out of the market. So we're looking at first-time home buyers primarily, but several others, also people depending on the type of financing they're using. People using federal financing are often finding themselves out of the market. In addition, looking at June, so this is sort of projected information I'm seeing. This is based on pending sales, so not sales that have come through. Contract signings fell by roughly 5%. Again, that says something to us about the supply more than it says about interest based on everything else we're seeing. In fact, total active listings are down 31% from a year ago, which again, I mean, that is their 3rd less listings this summer than last summer. And last summer, most of the country was under quarantine. I mean, there was a lot of restrictions related to the COVID-19 pandemic. So right now, there aren't as many, things are opening up, but yet we're still seeing a third less listings. So what is this really telling us? They're telling us that there's a real lack of supply. We're talking about supply in this webinar. There's a lack of residential homes. What is going on? Well, one thing that we've kind of been focusing on is we've actually been delving into the research of this quite a bit more. We commissioned 2 studies this year related to this. And, you know, one thing to note is that the growth of inventory has actually been slow since the start of the century, start of 2000. And especially the last decade, we've just seen so much less inventory created year by year. And so part of our research has kind of come up with this term, which is called the underbuilding gap, because we kind of are seeing that it has more to do with the building of homes than necessarily the sale of existing homes. So it's an underbuilding gap that's estimated at 5.5 to 6.8 million housing units since 2001. Now, of course, you guys have the home builders on this webinar, so I'm not going to really go into that. I'm just going to say that that's something, you know, we are concerned with, and leave it at that. In terms of the studies we did, so I mentioned that we're looking into this issue. So part of what we wanted with these studies was to come up with what is causing it, but what are solutions? Like, what can we do to look at this issue of supply? And so I did want to do a little plug that on July 15th at 1 p.m. Eastern, we're actually having our own webinar. It's called Housing is Critical Infrastructure, Social and Economic Benefits of Building More Housing. All the information for that is on nar.realtor. You can go right to our website, find all that up. And, you know, we're going to present one of these papers. We're going to have a panel discuss it. But just to give you guys a little preview, some of the things that have come out from this research that are going to be discussed is addressing, for example, there's shortages in capital and lending for the development of affordable housing. So how does that improve? Well, you know, there already are a lot of existing programs that do create affordable housing. What they need is more resources and, you know, more funding. We see a lot of barriers in the form of local zoning and regulatory environments. So, you know, what can be done to incentivize shifts to substantially increase the quantity and the density of developable residential space? You know, we have specifically another study on our website, State and Local Policy Strategies to Advance Housing Affordability. Again, nar.realtor, you'll find all the information I'm sharing today on our website. Definitely urge everybody to go there and explore around, but that goes into really, really specific kind of ideas on what a state or locality can do when it comes to zoning and affordability issues like that. Because the reality is a lot of the barriers when it relates to zoning or regulation are at that state and local level. Now we're a national association. I work for the national side, so I focus on my fellow staff members, we focus on federal rules, federal regulations. So, you know, there's a lot at the federal level you can try to do to incentivize improving zoning. For example, you know, HUD has certain programs of funding that communities can get, and there's NEDs that if you tie it to improving zoning rules, that could be it. The reality is that it's very much on the state and local level. And that's where a lot of change is going to have to happen. Flip side of that, I'm talking only about residential when it comes to supply, because we're almost seeing the opposite problem when it comes to commercial space. There is a ton of unused commercial space in this country right now. I think most people I talk to, and imagine many of you on this webinar, can sort of imagine a mall, for example, near you where maybe half the stores are gone. That's unused commercial space. A strip mall that's basically empty. People of you who might live in, like, you know, closer to larger metropolitan areas might see massive for lease signs on sort of, not the skyscrapers, but those tall kind of commercial buildings where you would have sort of the nondescript companies in it, and huge leasing signs everywhere. So there's a real underutilization of commercial space. What can be done with that, I mean, there's existing structures, many are in pretty decent condition. You know, those could be converted into residential. Those could be converted into multifamily. How does that get done? Well, I mean, it goes back into zoning, goes back into funding. It's not necessarily an inexpensive endeavor to turn an office building into apartments, obviously, but we're sort of looking at those things. That's how we want to think about improving supply, thinking outside the box, really trying to figure out what can we do to improve what's going on. And then, you know, in addition, this underbuilding gap is going to require a coordinated approach. You know, Bill was mentioning that everybody has to come together to really address some of the issues facing the appraisal valuation industry right now. Well, honestly, all of us in real estate, we're really going to have to come together to help with this underbuilding gap as well. We can't just, you know, lay all the blame on the home builders. So don't worry, Jessica, we're not doing that. But, you know, there's planning, there's funding, there's development of not just the structure, like the home structure, but the infrastructure that you need to, you know, create communities, to create places where people can live. You have to make sure that any housing you're creating is inclusive and it is well integrated into the local communities. Some of these mechanisms to do this, you know, again, there are programs out there. For example, HUD has its affirmatively furthering for housing framework, which, you know, again, is geared towards incentivizing communities to developing fair housing. How can we all work together to help states and local areas, you know, create affirmatively further fair housing that works, so that there's genuine community engagement? Again, since so much of this is state or really even, let's say, really local, you do want to make sure that your community is engaged in all this infrastructure development, this adoption of planning tools as it relates to analyzing these, as it relates to making major changes. So that's kind of just me wanting to give you guys the lie of the land a bit, and sort of this general view of where NAR is focusing. So, you know, obviously this is a webinar geared towards the valuation industry and appraisal. So, you know, how does appraisal and valuation fit into all this? I'm sure you're thinking, yeah, that's problematic, but what's there? So I do want to let everyone know that, you know, at NAR we have agent members and we have appraiser members. We have members who are brokers. Some of those brokers are agents and some of those brokers are appraisers. We have people who work in commercials. We have a range of members. I'm going to share a little bit more today about what I hear from the agent side, since I think that most of the people listening in today are in the appraisal field, and you probably know how you feel about the lack of inventory. So I don't feel like I want to lecture you about that, but let me just share at least what we're hearing from our agents in the field. They're worried. They're very, very worried. Obviously, if you look at the pricing of homes, you can think that, oh, some of these agents are benefiting, they're making so much money. But the sheer drop in volume of sales does affect quite a large proportion of our membership. If you don't have sales to make, you're making nothing, right? And the majority of agents represent borrowers and potential home buyers, you know, who aren't those top percentile people. Most of them don't represent those all cash buyers who seem to be getting all the listings right now. A lot of them represent, you know, borrowers who are using the federal financing programs, FHA and VA, which anecdotally we hear that those borrowers are not even being entertained by sellers. Like if they see FHA or VA, you know, financing on a offer, it's just rejected. I don't have data on that. This is just anecdotal information I'm sharing with you, but I'm hoping that kind of creates a picture of what's sort of going on. Now, when we hear something like that, and I'm going to focus a little bit more about what I just mentioned about the federal program borrowers being shut out by sellers, it's like, well, why? Okay, so you're telling me you're being shut out. Can you tell me why? Can you tell me what is it that they're telling you? This is why we don't want to entertain your offer. Well, one of the main things we hear is that FHA and VA have those minimum property requirements. And those of you who have done FHA and VA appraisals know that those requirements do go beyond what you have to do when you're dealing with conventional finance related appraisal assignments. And mixed in with that is the fact that not everyone does FHA or VA appraisals, right? For FHA, if you're a licensed residential appraiser, you're not even allowed to do it. That you've been allowed to do it for over 10 years now. For the VA, I mean, you have to be part of the VA appraiser. And so it's just a limited pool already. And what does that create? That can create longer wait times. So seller thinks like, okay, I'm gonna deal with a borrower that's gonna have a more intensive appraisal and there's gonna be a longer wait time. Like, yeah, I'm not even gonna touch that. That's a problem. It's unfair. It's very unfair for those borrowers who need that financing, who would be great homeowners, but just can't get over that hump. Now, I know in terms of at least the numbers, VA has been actively trying to recruit more people to their appraisal panel in recent years. My understanding is it's mixed results. They might have increased the number, but it's clearly not to the point that people feel satisfied that there are enough. And then with FHA, this one is interesting because in Congress for right now, there's actually several proposals. So I've seen a few bills running through Congress that would allow licensed residential appraisers to once again do FHA appraisal. And I've seen it standalone and I've seen it mixed in with other bills. So I'm not going to go into which bill number you need to follow. Just know that the idea is there. I know that the idea has really wide support from almost every congressional office that we at NAR talk to. Mostly because almost every congressional office we talk to, when you ask them about appraisals, they complain about a lack of appraisers in their area. So, NAR is supportive of this idea, and we definitely hope it gets passed. But, those are things that I feel that if you're in the appraisal and valuation, you should know these conversations are happening. So when we're talking about housing supply and how low it is, these are sort of the kind of related effects, that would affect your own business, for example, if you're an appraiser, as things this are. In addition, what about the clients, the borrowers who are competitive in the market? Do they have appraisal concerns right now? Well, they do, actually. The main one that we hear at NAR is that the appraisals and the appraisers are not taking into account rising market value in a reasonable way. Now, I have spoken with my members who are appraisers. I've spoken with Fannie and Freddie. I've spoken with staff at other appraiser trade organizations. So I'm not an appraiser. I'm not pretending to be an appraiser. I'm not going to tell you how to account for a rising market, but I have been very educated that it is possible for an appraiser to account for a rising market. It is possible for an appraiser to make the price adjustments, that work. So again, we go back to these markets across the country with these incredible year-over-year price increases and with a complete dearth of sales, which means that, you're probably not going to see a great comp within the past 6 months. To me, that brings up real analytical questions about how are you determining value? How can you determine value? Well, and I understand that might be a tricky question and that might be something that's being worked on. I'm not going into that. But, the result of it being that we do get a lot of complaints that somebody actually makes an offer, they get the offer, and then the appraisal is, comes in low with the idea that the appraisal is not taking into consideration that it's a rising market. Now, I know a lot of people will probably tell me, but agents have complained about low values like forever. They're always complaining about appraisals coming low. And yes, I totally get that. And I understand that, sometimes the data and the analysis just cannot support a contract price. No one is disagreeing with that. What I will say though is that the volume of concern we're hearing, that the amount of people who are, concerned that appraisals are not taking adequate, the appraisals really aren't taking real consideration of the rising market, not really making the price adjustments that are necessary, is significant. It's significant to the point where it is concerning. Now, I've also heard theories about why this might be happening. The main one being fear, right? Fear that an individual appraiser is really worried about the 2009, 2010 situation where there's a bubble and bust type scenario, and their industry is going to get blamed for everything that's wrong. And I hear that, and I do recognize that that's a concern. And again, I would never want anyone to feel pressured into making a value opinion that they don't believe the market data is there. But that being said, we at NAR, we are really concerned that adjustments for rising markets are maybe not being done as much as they should, or not being done as properly as they should. And then, finally, I did want to touch on one last thing, because I do want to be mindful of trying to make sure we have time for Jessica. Any questions? One thing Bill brought up was this, sort of the concerns with fair housing and valuation. He mentioned that there's a task force, or the government has a task force being led by HUD that's looking at concerns with discrimination and valuations. And I know that for maybe about 2 years now, it's been a hot topic. There was a congressional hearing. You hear all the news stories. And I'm just going to say that, this will be a major issue, and it will continue to be a major issue. And it's not something that's going to go away, so much as it's something that needs to be taken very seriously and addressed very seriously. Now, I know several, entities are doing that. The Appraisal Foundation, for example, is taking it seriously. I know the Appraisal Institute, Bill works for, is taking it very seriously, and that's really good. But it's so important that, appraisers and appraisal companies and everyone out there is also, really taking this issue seriously. I think there's often a knee-jerk reaction to defend oneself, and that's fine, because I'm not saying that any individual who's listening right now is, their appraisals, but you may not be the one that needs the help. So I just wanted to make sure that everyone is aware that it's not going anywhere, and it deserves to be addressed, and it should be addressed. And hopefully we'll still have time for more questions. Thank you.
Well, thank you, Sehar. The numbers that you shared are even more dynamic than we expected, even though we're in this market every day. Good recommendations for the possible improvements to the supply chain. And I'll definitely be signing up for your webinar on the 15th. So next we have Jessica Lynch, Vice President of Housing Finance at the National Association of Home Builders. Jessica has almost 20 years of public policy and government relations experience in Washington, D.C. In her current role at the NAHB, she has a primary responsibility is to monitor and analyze governmental actions and policies that impact both builder and consumer financing in multifamily and single-family housing markets. Prior to joining NAHB, Jessica worked on Capitol Hill for Congressman Rick Lazio from New York, who served as the chairman for the House Banking Subcommittee on Housing and Community Opportunity. So we think that the supply chain builders definitely come to mind, and Jessica will be presenting some amazing data for us today. So Jessica, the mic is yours.
Great, thank you very much. Hopefully you can hear me. I thank you for inviting me to join you again today. It has been interesting to see how the U.S. Has changed over the last year, and there is certainly a lot of speculation about what will be lasting impacts of the pandemic and what are transitory. So I'm going to start with an economic update. Strong economic growth is expected this year and next. The job market has recovered. The federal government has been very generous with stimulus, which is still making its way into the economy. The Federal Reserve has indicated that they will keep interest rates low through 2023. However, there are still some uncertainties related to the coronavirus, such as the vaccination rate and new strands of the virus. For the housing market, affordable issues still persist, and supply chain disruptions continue to be the biggest challenge. The NHB Wells Fargo Housing Market Opportunity Index measures the percentage of homes affordable to those with median income. Low interest rates were helping to keep homes affordable to more people, but house prices are now rising faster than incomes, which is negatively impacting affordability. So looking forward, NHB expects single-family starts to grow along long-term trends, although there is a widely recognized need for new supply, as we've been talking about, especially at the entry level. Supply chain disruptions will put a damper on construction for the next couple of years. The lack of supply is pervasive. Freddie Mac estimates that we have a national housing supply shortage of 3.8 million homes. And the remodeling market is also very strong. However, it is still hampered by the same supply chain disruptions. So we've talked in the past about some demand side factors, and that the millennial generation talked about the importance of them forming households as a key driver of demand. And so results from the NHB's Housing Trends Report for the first quarter of 2021 show that millennials are the most likely generation to have moved on from just planning a home purchase to actively buying and searching for a home. 73% of this generation's prospective buyers were already active buyers in the first quarter of 2021, which was up from 54% last year. Several factors are driving this trend, including the fear of missing out on still relatively low mortgage rates, desire for more space due to COVID-19, and the desire to move out to outlying suburbs. In addition, the share of buyers looking to buy a newly built home jumped up from 24% to 42% from the first quarter of 2021 to this year. On the other hand, the share looking for existing home declined 40% to 30%. Interestingly, though, the majority of millennial buyers would prefer to purchase a new home. So what is the holdup in meeting this demand? They're actually the same constraints that we talked about in our January webinar, except I think they've actually gotten worse. The NHB Wells Fargo Housing Market Index, or the HMI, measures single-family builder sentiment and is released monthly. In June, rising material prices and supply chain shortages resulted in builder confidence dipping. Despite the monthly decline, the rating above 80 is still a signal of strong demand in a housing market that lacks much-needed inventory. So let's look at some of the supply constraints. We've talked actually for the last several years, NHB's been talking the last several years about the 5 L's, we'll call them: lumber, labor, lots, laws, and lending. And so the first one we'll touch on is lumber. Lumber prices continue to be a huge challenge, and it has certainly gotten a lot of attention, so I'm sure you've been watching it. Softwood lumber prices fell to $689 last week after a peak spot market price of above $1,500, which is 54% lower than the peak price. It's important to know that there's a lag between declines in the spot pricing and pricing paid by builders. In fact, as the price declines began grabbing headlines, the price of lumber packages quoted to builders held at record highs. Home builders and remodelers will begin to get price relief once mill prices have substantially decreased for an extended period. And even if supply chains for lumber deregulate and prices become less volatile, prices are expected to remain above pre-pandemic levels. Unfortunately, it's not just lumber that has gotten more expensive, and not all material pricing is coming down. For example, OSB pricing is up more than 350% year over year. In fact, building material costs have soared 26% on 26-point average over the last 12 months, according to a May NHB survey of single-family builders asking how much costs have increased from the same house over the last year. The same May survey reveals that a number of a record number of builders, reported material shortages across the board. Shortages of materials are now more widespread than at any other time since NHB began tracking the issue in the 1990s. The vast majority of builders report shortages of appliances, framing lumber, OSB, and plywood, and windows and doors. So it is pretty widespread. Skilled labor shortages still persist. This graph shows the open construction jobs for both residential and commercial. Shortages of lots, we've talked about this before too. I mean, builders have been complaining about lot shortages basically since 2013. And as I've mentioned, it takes a long time for developing land. So this is not going to, it is taking a long time to work through. The next L is laws or regulations. Regulatory costs are a major factor in affordability for newly constructed homes. In May, NHB released an updated cost of regulation study that found that regulations imposed by all levels of government accounted for $93,870, or about 24% of the current average sales price of a new single-family home. Importantly, the study on the cost of regulation does not take into effect how rising lumber and other material prices over the last 12 months have raised housing costs. So the next L is lending. The main concern we've heard about is related to appraisals. With the input costs rising so quickly for new construction and remodeling, appraised values many times are not sufficient to cover these costs. But the other L, which would be builder lending, is actually easing, so that's good. And so how are builders responding to these constraints? According to NHB surveys, the most common strategies were to raise prices on homes, pre-order materials, add price escalation clauses, wait until late in the construction process before listing spec homes, cost plus pricing. Some builders are abandoning projects or canceling contracts, further exacerbating the supply shortage. So turning to the policy discussion, President Biden has been true to his policy priorities. In talking with staff across the agencies, they continue to repeat these four main policy priorities of the coronavirus pandemic, economic recovery, racial equity, and climate change. In particular, we have seen the actions the administration has taken related to racial equity and climate change impact housing. NHB continues to press housing affordability and access to safe, decent housing as main considerations in these discussions. And to turn to appraisal specifically, once again, I'd like to reiterate NHB's support for the appraisal industry. Fair and accurate appraisals are a critical part of the housing finance system. Earlier this year, the Federal Housing Finance Agency, which regulates Fannie Mae and Freddie Mac, issued a request for information on appraisal practices. NHB responded with the same key issues we've talked about before: better data, more transparency, better communication and education, use of the cost approach for new construction, and a streamlined reconsideration of value process. Since then, there has been a change of leadership at FHFA, so future action on appraisals by that agency remain to be seen. I'm also going to once again advocate for the use of the cost approach to appraisals for newly constructed homes. Many times, consumer preferences focus on trends that you can see, such as granite or natural stone countertops, bathroom features, etc. However, there is value in energy efficiency, water conservation, indoor air quality, and net zero homes, especially as climate-related issues grow in importance. These items must be accounted for. So we are encouraging builders to provide information on these features to appraisers, and they've actually had a lot of luck when they talk about how they've been communicating better with appraisers. Anyway, because of the timing, with that, I will turn it back to Greg. Thank you very much.
Well, thank you, Jessica. Pretty amazing data you shared with the audience today. And yes, appraisers are experiencing challenges keeping up with the rising markets just in pricing in general, but also with the new construction costs when doing new construction and keeping up with those costs, because even the national cost data services are not able to keep up. So we definitely have some challenges ahead of us, and I don't see that diminishing in the short term. So it is something that we should be addressing, and I'm glad that you brought that up. So we are running right up against the hour. We're running out of time for Q&A. Some of our presenters did have a hard stop at 3 p.m. So what we'll do is, if you have questions, you can post those on the Appraisal Buzz website, and then we will publish the answers, and that way they can be available for everybody to view down the road. I want to thank you again, the three presenters, for sharing their perspectives and updates with our webinar audience today. Also wish to thank all of you that participated today in this Metro West Appraisal Buzz webinar. Hope you have a great rest of your day and week. Thank you again, everybody.
Thank you very much.
Thanks, everybody.
Thank you all so much for joining us for today's Appraisal Buzz webinar. Also, thank you Metro West for offering this webinar for everyone for free. If you would like to join Metro West panel, I'm sending an offer right now. You can apply through the button on this screen. But thank you, everyone, for joining us. Thank you, Bill, Sehar, and Jessica. That was very enlightening. Everyone have a great day. And email us at info@appraisalbuzz.com or comments@appraisalbuzz.com if you have any of those questions.
Thanks again, everybody. Great webinar.